You know that feeling when you're looking at your bank account, calculating whether that $10,000 sitting there could actually change your life? Maybe you inherited it. Maybe you finally saved it up after years of discipline, or maybe you just sold something valuable. Whatever the story, you're staring at this number thinking there has to be a better way to put this money to work than letting it collect dust at 0.01% interest in your savings account. Most people treat $10,000 like it's either not enough to matter or too precious to risk. They'll agonize over whether to pay off debt, dump it into a retirement account, or just keep it as emergency money. But here's something that might surprise you. $10,000 isn't just money sitting in your account. It's a machine waiting to be built, a system that could generate consistent monthly income for decades to come. My name is Alex, and I spent the better part of my career in investment banking watching wealthy clients turn modest amounts of capital into reliable income streams. After retiring in my mid-30s, I've made it my mission to break down these strategies for regular people who don't have access to private wealth managers or exclusive investment opportunities. If you've ever wondered how to transform a lump sum into genuine passive income that shows up in your account every single month, make sure to hit that subscribe button because we're about to dive deep into the mathematics and psychology of income generation. Now, before we get into the specific strategies, let me address the elephant in the room. When I say passive income, I don't mean the fantasy version that gets peddled online where you set something up once and money magically appears forever without any effort. Real passive income requires upfront work, ongoing management, and a clear understanding of risk versus reward. But when done correctly, it can provide genuine monthly cash flow that doesn't require you to trade your time for money. The target we're aiming for is $1,000 per month from your $10,000 investment. That's a 12% annual return, which might sound aggressive if you're used to traditional savings accounts, but it's absolutely achievable when you understand the right vehicles and strategies. The key is diversification across multiple income streams rather than putting all your eggs in one basket and hoping for the best. Think about wealthy families for a moment. They don't rely on a single source of income. They have rental properties generating monthly rent, dividend stocks paying quarterly distributions, business investments throwing off profits, and bonds providing steady interest payments. This diversification protects them when one income source has problems while ensuring consistent cash flow throughout different market conditions. Your $10,000 can create a similar structure on a smaller scale. Instead of trying to find one perfect investment that delivers 12% annually, we're going to build a portfolio of income-generating assets that collectively hit our target while managing risk through diversification. The first component of our income strategy focuses on dividend growth investing. This isn't about chasing the highest dividend yields you can find, because those often come from companies with unsustainable business models. Instead, we're looking for established companies with long histories of increasing their dividend payments year after year. These dividend aristocrats provide both growing income and capital appreciation over time. Here's how the mathematics work. If you allocate $3,000 to a diversified portfolio of dividend growth stocks yielding an average of 4% annually, you're generating $120 per year in dividend income. That's $10 per month from this portion of your investment. But here's where it gets interesting. These companies typically increase their dividends by 3 to 5% annually, which means your income grows automatically to keep pace with inflation. The beauty of dividend growth investing is that you're not dependent on stock price movements to generate income. Whether the market goes up or down, established companies continue paying dividends to their shareholders. During market downturns, you can reinvest these dividends at lower prices, accelerating your income growth when markets recover. The second pillar of our strategy involves real estate investment trusts, commonly known as REITs. These are companies that own and operate income-producing real estate, and they're required by law to distribute at least 90% of their taxable income to shareholders. This creates naturally high dividend yields, typically ranging from 4 to 8% annually. REITs give you exposure to real estate without the hassles of being a landlord, No dealing with tenants, maintenance issues, or property management headaches. You simply own shares in professionally managed real estate portfolios that could include apartment buildings, shopping centers, office buildings, warehouses, or specialized properties like cell phone towers and data centers. By allocating $2,000 to a diversified REIT portfolio yielding 6% annually, you're generating $120 per year or $10 per month in additional income. REITs also provide inflation protection since rental income and property values tend to rise with inflation over time. The third component involves peer-to-peer lending platforms that allow you to lend money directly to individuals or small businesses. These platforms have evolved significantly over the past decade, offering more sophisticated risk assessment tools and diversification options. While returns can be higher than traditional fixed income investments, they also carry more risk since you're essentially acting as a bank. Modern lending platforms allow you to spread small amounts across hundreds of different loans, reducing the impact if some borrowers default. Expected returns typically range from 6 to 12% annually, depending on the risk level you're comfortable with. Allocating $1,000 to peer-to-peer lending could generate $60 to $120 annually, adding $5 to $10 monthly to your income stream. The fourth pillar focuses on high-yield bonds and bond funds. While government bonds currently offer relatively low yields, corporate bonds and international bonds can provide significantly higher income. High-yield corporate bonds, also known as junk bonds, offer elevated interest rates because they come from companies with lower credit ratings. The key is finding the sweet spot between yield and safety. Investment-grade corporate bonds might yield 4 to 6% annually, while high-yield bonds could offer 7 to 10%. By allocating $2,000 to a diversified bond portfolio yielding 5% annually, you generate $100 per year or roughly $8 per month. The final component involves covered call strategies on stable dividend-paying stocks. This is a more advanced technique that involves selling call options on stocks you own to generate additional income. When done correctly with established companies, covered calls can add 2 to 4% annually to your returns while providing downside protection. This strategy works best with large, stable companies that don't experience dramatic price swings. You collect the option premium up front, which becomes pure income if the stock price remains below the strike price. If the stock gets called away, you keep the premium plus any capital gains up to the strike price. By allocating $2,000 to a covered call strategy, you could generate an additional $150 to $200 annually, adding roughly $15 per month to your income stream. When you combine all 5 components, you're looking at potential monthly income of $50 to $60 from your $10,000 investment. That might seem far from our $1,000 monthly target, but remember that this is just the foundation. The real power comes from reinvesting this income and allowing compound growth to accelerate your progress. Here's where most people make their biggest mistake. They take that $50 or $60 per month and spend it on coffee or entertainment, essentially killing their compound growth potential. Instead, successful income investors reinvest every dollar of passive income back into income-generating assets. This creates a snowball effect where your income generates more income, which generates even more income. Let me show you exactly how this reinvestment strategy transforms your timeline from decades to years. Most people think building serious passive income takes 20 or 30 years, but that's only true if you're starting from zero every month. When you reinvest your passive income, you're essentially adding to your principal every single month without touching your own paycheck. Let's run the real numbers because this is where things get exciting. That initial $50 per month might not seem like much, but when you reinvest it at the same return rates, you're adding $600 annually to your income-generating portfolio. By year 2, you're not working with $10,000 anymore. You're working with $10,600, generating proportionally more income. This is where the mathematics start working in your favor instead of against you. By year 3, you might be generating $70 per month. By year 5, you could be looking at $150 monthly. The acceleration happens gradually at first, Then suddenly, almost like watching a boulder roll down a hill that keeps picking up speed. But here's something most financial advisors won't tell you because it doesn't fit their traditional models. You don't have to wait for this slow compound growth to reach your $1,000 monthly target. There are acceleration strategies that can compress your timeline dramatically if you're willing to be more active in your approach. The first acceleration technique involves what I call income laddering. Instead of reinvesting all your passive income back into the same assets, you systematically move up to higher yielding opportunities as your capital base grows. Remember, many of the best income opportunities have minimum investment requirements that put them out of reach for smaller investors. Private real estate syndications, for example, often require minimum investments of $25,000 to $50,000, but they can generate annual returns of 12 to 18%. Business development companies that lend to middle-market businesses might require similar minimums but offer yields of 8 to 12%. These opportunities aren't available when you're starting with $10,000, but they become accessible as your portfolio grows. Here's how income laddering works in practice. You start with your diversified foundation generating that initial $50 to $60 monthly. But instead of just reinvesting into the same assets, you're systematically saving and reinvesting toward the next tier of opportunities. Once you've accumulated enough additional capital, you move a portion of your portfolio into these higher-yielding investments. This creates a step function rather than a smooth curve. Instead of gradual growth, you experience periodic jumps in your monthly income as you access better opportunities. The timeline to reach $1,000 monthly compresses from 15 or 20 years down to 7 or 8 years using this approach. The second acceleration strategy involves what I call active passive income. This sounds contradictory, but hear me out. While traditional passive income requires no ongoing effort, active passive income involves creating systems that generate income with minimal ongoing time investment, but require some initial setup and occasional management. Creating digital products that solve specific problems can generate substantial monthly income once established. Online courses, software tools, or information products can produce income for years after the initial creation work. The key is choosing topics where you have genuine expertise and there's demonstrated market demand. I know someone who created a specialized Excel template for small business cash flow management. It took him about 40 hours to develop and set up the sales system. That template now generates over $2,000 monthly in passive income. 3 years later, he spends maybe 2 hours per month answering customer questions and updating the product. Another approach involves creating content that generates advertising revenue or affiliate income. This could be a blog, YouTube channel, or podcast focused on topics you're genuinely passionate about. The income potential varies widely, but successful content creators often generate hundreds or thousands of dollars monthly once they build an audience. The third acceleration technique is probably the most powerful, but it requires the right mindset and risk tolerance. It involves using your growing passive income as proof of concept to attract outside investment or partnerships. This is where your $10,000 foundation becomes the seed for something much larger. Once you can demonstrate consistent monthly passive income generation, you become attractive to other investors who want to participate in your strategies. Maybe you've become skilled at identifying undervalued dividend stocks or finding profitable real estate opportunities. Other people with capital might be willing to provide additional funding in exchange for a share of the returns. This approach can dramatically accelerate your income growth because you're no longer limited by your own capital. If you can generate 12% annually on $10,000, you can potentially generate 12% annually on $100,000 or $500,000 with the right partners. But here's the critical part that separates successful income investors from everyone else. You have to become genuinely good at generating returns before you can scale up. There's no shortcut or hack that bypasses the learning process. You need to understand market cycles, risk management, and due diligence procedures. You need to experience both winning and losing investments so you develop proper judgment. This is why I always recommend starting with your own money first. $10,000 is enough to learn the fundamentals without risking your financial future. You'll make mistakes and some investments won't work out as planned. But these lessons are invaluable when you're managing larger amounts of capital later. The psychological aspect of passive income generation is just as important as the technical aspects. Most people sabotage their own progress because they can't handle the emotional ups and downs of investing. They panic during market downturns and make emotional decisions that destroy their long-term returns. Building successful passive income requires developing what I call investor temperament. You need to think in years and decades, not weeks and months. You need to stay focused on income generation rather than getting distracted by capital appreciation. Most importantly, you need to maintain discipline during both good times and bad times. During bull markets, you'll be tempted to abandon your diversified approach and chase whatever's performing best. During bear markets, you'll want to sell everything and hide in cash. Both impulses will destroy your income-building progress. Successful income investors stay consistent regardless of market conditions. The tax implications of passive income generation deserve serious consideration because they can significantly impact your net returns. Different types of income receive different tax treatment, and understanding these differences can help you optimize your after-tax income. Qualified dividends from U.S. corporations receive favorable tax treatment, often taxed at lower capital gains rates rather than ordinary income rates. REIT dividends, however, are typically taxed as ordinary income. Interest from bonds is usually taxed as ordinary income, while income from certain partnerships might receive more favorable treatment. Understanding these tax implications allows you to structure your portfolio more efficiently. You might hold tax-inefficient investments in retirement accounts, while keeping tax-efficient investments in taxable accounts. Or you might time certain income recognition to optimize your overall tax situation. Tax optimization becomes even more important as your passive income grows. What starts as $50 monthly might not trigger significant tax implications, but once you're generating several hundred or thousands monthly, tax efficiency can make the difference between reaching your goals and falling short. This brings us to a crucial concept that most people completely overlook when building passive income. Geographic arbitrage and international diversification can dramatically amplify your purchasing power. That $1,000 monthly might provide a comfortable lifestyle supplement in expensive U.S. cities, but it could fund a luxurious retirement in lower-cost international markets. I've worked with clients who built modest passive income streams in the U.S., then relocated to countries where their dollars stretch significantly further. Suddenly, their $800 monthly passive income covers their entire cost of living instead of just supplementing their expenses. This geographic flexibility becomes a powerful multiplier for your income-building efforts. International dividend stocks and bonds also provide currency diversification benefits. When the U.S. dollar weakens, foreign investments often provide natural hedging. Some of the world's most reliable dividend-paying companies are based outside the United States, offering yields and growth prospects that complement domestic investments. But here's where things get really interesting, and this is something most financial advisors never discuss because it doesn't fit their cookie-cutter approach. The most successful income investors I know don't just build diversified portfolios and wait for compound growth. They develop what I call income intelligence, which is the ability to spot and capitalize on income opportunities that others miss. Income intelligence comes from understanding market cycles and positioning yourself to benefit when others are panicking. During the 2008 financial crisis, high-quality dividend stocks were trading at historically low prices while offering elevated yields. Investors with cash and courage could lock in double-digit dividend yields that continued paying throughout the recession. Similarly, during the early pandemic months, many REITs traded at massive discounts despite owning essential properties like warehouses and data centers. The panic selling created opportunities for income-focused investors to acquire assets at prices that wouldn't be seen again for years. Developing this intelligence requires studying market history and understanding what creates genuine opportunities versus value traps. You need to learn the difference between companies cutting dividends due to temporary difficulties versus those facing permanent business model changes. You need to understand when elevated yields reflect genuine value versus impending dividend cuts. This education process never stops because markets constantly evolve. New income opportunities emerge while others become less attractive. The rise of renewable energy created entirely new categories of income-generating investments. The growth of e-commerce transformed the real estate landscape, making some property types more valuable while others became obsolete. Staying ahead of these trends allows you to position your portfolio for maximum income generation. Maybe you recognize that data center REITs will benefit from artificial intelligence growth, or you identify that certain utility companies will profit from electric vehicle adoption. These insights come from continuous learning and market observation. But let me share something that might surprise you about the psychology of building passive income. The hardest part isn't learning the technical aspects or finding the right investments. The hardest part is maintaining discipline when your strategy is working exactly as planned. Here's what I mean. Once your passive income reaches $200 or $300 monthly, you'll face constant temptation to spend it. Your brain will rationalize that you deserve to enjoy the fruits of your investment success. Maybe you'll tell yourself that taking just $100 monthly won't hurt your long-term progress. This is where most people derail their income-building journey. They start treating passive income like extra spending money, instead of the foundation for financial independence. Every dollar you spend instead of reinvest adds months or years to your timeline for reaching meaningful income levels. The successful income investors I know treat their passive income like it doesn't exist until it reaches levels that truly matter. They automate the reinvestment process so they're never tempted to spend it. They focus on growing their primary income sources while allowing their passive income to compound undisturbed. This requires shifting your mindset from short-term gratification to long-term wealth building. Instead of asking whether you can afford something, you start asking whether purchasing it moves you closer to or further from your income goals. Every financial decision gets filtered through the lens of opportunity cost. The compound effect of this discipline is staggering. The person who reinvests every penny for 5 years will have dramatically more monthly income than someone who spends even small portions along the way. We're not talking about minor differences here. We're talking about the difference between reaching your $1,000 monthly target in 7 years versus 15 years. Another critical aspect involves understanding the relationship between risk and income generation. Higher yields almost always involve higher risks, but the key is taking intelligent risks rather than gambling. You want to be compensated for risks you understand and can evaluate, while avoiding risks that could permanently impair your capital. This is where many income investors make expensive mistakes. They chase the highest yields available without understanding what creates those yields. Maybe they buy a stock yielding 12% without realizing the company is drowning in debt and likely to cut its dividend. Or they invest in exotic instruments they don't understand because the marketing materials promise outstanding returns. Intelligent risk-taking involves thorough due diligence and position sizing. You might allocate a small portion of your portfolio to higher risk, higher yield opportunities while keeping the majority in stable, predictable income sources. This allows you to benefit from successful speculation without jeopardizing your core income stream. The position sizing aspect is crucial because it determines whether a bad investment becomes a minor setback or a major disaster. If you put 10% of your portfolio into a speculative opportunity and it fails completely, you've lost 10% of your capital. If you put 50% into the same opportunity, you might have destroyed years of progress. Professional investors use position sizing rules that limit their exposure to any single investment or strategy. They might never put more than 5% of their portfolio into any individual stock, or never allocate more than 20% to any single asset class. These rules prevent emotional decision-making during both euphoric and panic market conditions. As your passive income portfolio grows, you'll also need to consider estate planning and wealth transfer strategies. Building substantial passive income streams creates assets that can benefit future generations if structured properly. This might involve setting up trusts or other vehicles that allow income to continue flowing to your beneficiaries. The beauty of income-generating assets is that they can provide financial security for your family long after you're gone. Unlike savings accounts that get depleted over time, properly managed income portfolios can grow and provide increasing cash flow for decades or centuries. But perhaps the most important lesson I can share about building passive income is that it fundamentally changes your relationship with money and work. Once you have genuine monthly income flowing from your investments, you start making career and life decisions from a position of strength rather than desperation. Maybe you take a job you're passionate about even though it pays less because your passive income covers the difference. Maybe you start a business or pursue creative projects because you're not dependent on them for survival income. Maybe you retire early because your investment income covers your lifestyle expenses. This freedom to choose is the real value of passive income generation. The monthly cash flow is important, but the optionality it creates is transformational. You stop being a slave to your paycheck and start designing your life around your values and interests rather than just your financial needs. The journey from $10,000 to $1,000 monthly passive income isn't just about financial returns, it's about developing the skills, mindset, and discipline that create lasting wealth and genuine financial independence. Every dollar you reinvest, every market cycle you weather, and every investment lesson you learn builds the foundation for long-term prosperity. Most people never start this journey because they're waiting for perfect conditions or complete knowledge. They want guarantees that don't exist and certainty in an uncertain world. But the investors who achieve meaningful passive income understand that starting with imperfect knowledge beats never starting at all. That $10,000 sitting in your account isn't just money. It's the first domino in a chain reaction that could transform your entire financial future. We've covered the 5-pillar strategy, the acceleration techniques, and the psychological discipline required to turn that lump sum into a reliable monthly income machine. The mathematics work, the strategies are proven, and the only question remaining is whether you're ready to stop treating your money like it's too precious to put to work. Remember, every month you delay is another month that compound interest isn't working in your favor. And time is the one resource you can never buy back with any amount of money.